Today, I am with Paulo, a friend of mine, and we hear a lot nowadays about why you should buy a home, the rates and all these other things. And today, we're going to tell you why you shouldn't buy a house. And with that said, Paulo, how are you doing today?
I'm great. Thanks so much for having me, Amit. It's great to be here.
You're welcome. Nice to have you.
Absolutely. Absolutely. So a little bit about me real quick. I am a mortgage professional. I've been doing this for 17 years. I got in 2005, right before the crash, endured that, and have been loving what I do ever since. My first foray into being a homeowner included doing everything wrong. In 2006, I was 24 at the time. I didn't know what I was doing. I didn't have a down payment, but I purchased a property at the top of the market with 100% financing. Back then, we were doing something called an 80-20, 80% first mortgage, 20% second mortgage. I did both of them on interest only, so I never amortized anything. And I wanted to keep my cash flow down. And I was actually buying this house for my parents. So I had a good intention. I just didn't time it well. 4 short years later, by 2010, let's see, Zillow had the property value at less than half of what I paid for. So went from 250,000 purchase price down to 110,000. And so at that point, I thought, okay, what do I do here? Do I walk away? What on earth do I do? And I decided to stay the course. But by that time, my parents had moved out. I had a tenant in there, and the tenant was paying the majority of the expenses of the property, the mortgage, the taxes, insurance, the HOA. Fast forward to last year, I actually ended up selling the property for a profit. I sold it for $299, having purchased for $250. But more importantly, the tenant during all that time paid down the mortgage, so paid a lot of my equity that I ended up taking out of there. So what's interesting about that story is that you can do everything wrong, but if your time horizon in real estate is long enough, you're probably going to do okay. And so that's a conversation I have with a lot of nervous buyers who think that maybe the market might crash. And say, okay, let's say it will crash. Well, you shouldn't be in this for the short term. This is a long game. So that's my story.
Yeah, no, I like your story, and especially you were 24 years old. It's pretty difficult to think that be that forward thinking at 24 to think my property's worth half of what it is. Everyone else is giving their properties back, and I'm going to keep it. So you said back then you did 100% mortgage at 80-20. How much just out of curiosity, how much money did you actually bring to the table when you closed?
Oh, great question. It wasn't a whole lot. So the property was in Georgia. So the closing costs are moderate. Maybe it was, I don't know, 6,000 or 7,000.
It's crazy because the story makes a lot of sense, especially in Miami. But if you do things wrong, even if it's not in Miami, like in Georgia, where properties probably don't appreciate as quickly as here, you can still do well. So yeah, so the topic of our thing is why you shouldn't buy a home. So let's get into some reasons from you why people shouldn't buy a home besides the basics,
Yeah, absolutely.
Whatever you think of.
Absolutely. So I think it's a great segue because I just gave my first and foremost answer. You should not buy a home if your intent is something short term. If you're an investor that's intending to flip, yes, there are investors in the market that time things well and they make money, but that's also how you can lose your shirt. More importantly, for a first-time home buyer or just a primary residence buyer, I don't ever recommend purchasing something with the intent to be in it for a short, let's say 2 years. I coach all my clients that I want to deal with them on a long-term basis, and their outlook should be, on the order of a decade. Yes, many people say I'll move out in 7 years. Okay, and then we can talk about if that becomes a rental property, if you sell that property and transition the equity into a new property. But I think my first and foremost reason is you should not buy a house if you're speculating. You should not buy a house if you're in it for the short term. What about you? What's your reason?
Yeah, that makes sense. As far as flipping, you mentioned flipping. I probably wouldn't be. As agents, we get sold more than many of us sell. Every day we're getting 10, 15, 20 calls from people trying to get us to do stuff. And so many of them are investors that are asking, hey, do you have a property that needs work and all that? And it's okay if someone has cash and they have a crew that has done this many times. But if you're a first time investor and you haven't done any flips, and obviously labor is more expensive, supplies are hard to get. If you're buying something and in your mind you think it's a good flip, I would probably caution against that. That would be one of the things I would say.
Yeah, absolutely. Absolutely have to agree.
So, okay, so we know short term is bad. Also, flipping is bad. Any other things that you could think of why someone shouldn't buy now?
Let's see. I think, every client, if they're lucky enough to be with an agent like yourself, or a finance professional like myself, we're going to ask very direct questions as to their life situation, right? So my thought process in that is I never get very far with a client without knowing exactly what their job situation is, exactly what their upcoming change of life circumstances are. If there is not a first-time home buyer, but first-time parents that are trying to upsize into a home, we have to take a very good look at, okay, what's the cost of that new home going to be? And I'm a parent of two. I know how expensive those little guys are. So, I'm going to want to coach an increasing family size, like, hey, just this is coming. So this is going to eat into your disposable income. So I think that, the more general answer to the question is, we really have to analyze each client's situation individually. There are clients right now for who it does make sense to buy. And there are also clients right now who it does not make sense to buy. And that's where you come in that interview process, right?
Yeah. I love how you said about their lifestyle situation, right? What's going on in their life, whether if they're a new parent, or I get a lot of clients that are buyers that do two things. One, either gets divorced and is purchasing a home, or is moving to Miami. And from somewhere else, they're getting job transfer, like you had mentioned, their job situation. And what I usually recommend them, unless they really know Miami well, as far as someone moving here, maybe rent first or stay with the relative first. Get to know where you feel comfortable going to the Publix or the gym or whatever you like to do, where that is in relation to where you want to live. Also, if you're getting divorced, you probably don't know how your expenses are going to be. Obviously there's an emotional aspect of everything that we do. So knowing that question is great. So yeah, we were both discussing this offline. There are a few different questions that we asked. So I asked 4 questions, and then you can add to whatever you're going to add. But I think when we ask clients questions, if we know how many questions we're going to ask, it makes sense to tell them we're going to ask you 4 questions or 3 questions. Because if we don't, and we just start asking questions, they're going to be like, when are these questions going to stop? When are you going to help me? So
Yeah.
the first question is motivation. And I guess we can speak about each of them as we go along.
Yeah.
And we can see, based on this, you could tell me, would this person be good? If I say, okay, first question is motivation. Tell me what would be a good buyer and a bad buyer at this time with their motivation.
Yeah, absolutely. So a good buyer would be somebody who is need-based, right? So let's take a very stereotypical example of what's happening right now. Somebody moving down into the city from out of state due to a job change, or they're just moving for tax purposes. There's any reasons why people are moving to Miami right now. And perhaps they want to lock down something near a good school district because they have kids. And as you know, as much as I love Miami, the public school system could do a little better. So location really matters, right? So a good buyer is somebody with a very definite purpose in mind. That being not just, oh, I need to move to Miami to change my tax situation. You could do that renting, but securing a long-term dwelling nearby the school to which you want to educate your kids, very, very important person. So that would be definitely a motivation that I would support, and it's one that I see all the time.
So yeah, that makes sense as far as like moving for schools and all that. And just like you had mentioned too, the opposite, right? if someone doesn't know their job situation, one of the hardest things to do, I don't have kids, but probably is to move a family. And if those kids are young and they're going to a school and you're buying the property and you may have to move in a year or two, you may not just have to deal with emotional stress from the move and the kids and everything else. The financial stress could just kill you,
Yeah.
if that happened.
Yeah. And that's a
Okay.
perfect example of what the topic of this talk is, right? An example of why you should not buy a home, what you just described.
Yeah. So the second question I ask is, what are their expectations? So you being a professional, doing this for quite some time, I know a lot of people, they'll say, okay, I bought something 5 years or 10 years ago, but I know as a professional, you need to know information probably weekly, sometimes daily. So what would be some of the expectations? Say that person meets the criteria to buy right now. What would be some of their expectations from, I guess, let's just go through it, right? From beginning when they first call you or text you to like closing. What would the situation be?
Yeah, absolutely. We want to keep the current market in mind in terms of a strategy. And because the market is still competitive from a standpoint of a lack of inventory, even though inventory is rising some, which is great, we still have a shortage of it. And so when we go to make offers on behalf of clients, when you go to make an offer on behalf of a client, we need to put your best foot forward, especially if we're submitting an offer with financing, because we're going up against cash contracts. So what a prospect could expect is a conversation with me, 15, 20 minutes on the phone. Doesn't have to be in person, but it can be. I will ask some very specific questions related to their situation so that I can determine what documents I'm going to need for them in order to qualify them for the loan. I'll also send them a mortgage questionnaire, which will take 15 minutes online to complete. Once they get all those things back once we get all those things back from them, we do two things. One is I pre-qualify the client. That means that's exactly what it sounds like. I'm looking through the numbers, I'm looking through the documents, checking all the boxes and making sure, hey, this person qualified. Most lenders, not all, but most lenders will stop there and they'll send you a pre-qualification letter, which in the real estate community has a bad rap because sometimes people don't even look at documents and they just issue the letter, which is completely unprofessional. We take it one step further. We will go ahead and send the client into underwriting. And an underwriter, for those that don't know, is essentially the person that approves the loan. It can't be me because that's a conflict of interest because I'm representing the client. It needs to be somebody more of a neutral base, also employed with my company. That's called an underwriter. And their signature is what approves the loan. We want to get that done before you even make an offer, before you even go out taking them shopping, because that's how we solidity where the limits are. How much can we afford to buy, right? We want to know where all the limits are, how much down payment, how much, what the price of the property, the max price of property is. So we'll send them into underwriting. We'll get a full loan commitment for them. And then at that point in time, they'll be ready to shop with you. We'd have done 90% of the work up front. We'd have collected all the income and asset docs, looked at credit, etc. At that point, then you go out shopping with you. They submit an offer, get it accepted. We do an appraisal, we get title, and we go to closing. All in all, that process, it doesn't have to take longer than 30 days. Once we have the pre-approval, we can close in as quickly as 14 to 21 days, depending on the type of loan, right? Because we've done all the work up front. We just have to do an appraisal, title, get the seller out of the house, right? And then a lot of times that's the holdup. And then we can close. That's really what they should expect.
Okay, so let me peel back the layers a bit. Okay, so bank statements, how many months? Is it a month? Is it 2 months? Is it a few months? What would the person need to have?
Okay, so there's different documentation types, right? So the first place we look is what we call full documentation. We're looking at your income. If you're employed, it's W-2 and pay stubs. If you're self-employed, looking at your business and personal tax return. Sometimes, especially with the latter, the self-employed client, because a self-employed client may write off a lot of expenses against their income, they might bring their taxable income down. So what that creates is a situation where they can afford more house than they qualify for, right? They have the cash flow to pay for a house, but their taxable income is low. And so full documentation guidelines don't serve their interest. So the next step down would be a bank statement loan. So that's where we look at the last 12 months bank statements, whether they're personal or business. And so there's part answer to your question. If we're doing a bank statement loan, we need 12 bank statements. And And then from there on, we get into different types of loans. Let's say for investors, where we just use the market rent to qualify. That's called a debt service coverage ratio loan, with DSCR. There's also loans for somebody with a 1099, and also somebody with a lot of liquidity. It's called an asset depletion loan. Now, for the purpose of documenting their assets, so you asked me about bank statements. In most cases, you're just presenting two statements, 2 to 3 statements, depending on the program. More statements are needed when you're qualifying for a bank statement loan, because now you need to use the bank statements as income, or of course, an asset depletion loan when we need to show a little bit more history.
I like how you describe that. There are multiple different loans, and it depends on the type of loan, how much documentation you need. And I would assume the most qualified buyers probably would need the least, and the ones that for whatever reason, whether the income or credit or whatever, probably need the most. Is that accurate or no?
It's very intuitive and logical what you're saying, but unfortunately, a lot of the times it works a little backwards. So the most qualified clients that can document the most get the best rates. But for those rates, they're going to work a little harder, right? So for a self-employed client that we're doing full doc, I'm going to need personal and business tax returns for the last 2 years and the P&L. That's a lot more work than getting just 12 bank statements, and even more work than the investor who doesn't even present income. We just use the rent of the property to qualify for the loan, right? So there's a rite of passage to that best rate, and that's through the effort and documentation you provide up front.
That makes sense. I've never heard it described that way, but it does make sense. Yeah, if you want to get the best rate, you got to do the most to get it. When we talk about credit scores and stuff, I hear so much misinformation in the real estate market. It's usually someone not in the business or someone who did something many years ago and things have changed. With credit scores and stuff, what does someone need to qualify? I know there are different types of loans and stuff like that, but on average.
Yeah, look, it's going to vary from company to company. With us, we don't have a minimum credit score. The reason I say that is because our FHA programs, that's Federal Housing Authority, which is really a quasi-government, well, it is a government program. It doesn't have a minimum credit score, provided that you can reach certain criteria. Now, other programs start kicking in at 620 and above. So your bank statement loans, maybe 660, your full documentation loans, especially the jumbo ones, maybe 680 and above. So that's kind of the credit scores that the algorithms are looking for.
Okay. Is there something, and this may be a difficult question to answer, but is there something that someone wouldn't think of that would disqualify them from a mortgage?
There are several, absolutely. I think, a couple of things come to mind. And one of them is making any purchases during the loan process. We see this from time to time. Somebody buys a car or a boat halfway through, or they change their job halfway through the loan process. That's actually part of our standing operating procedure to speak to a client about those things at the time of application. Like, I need you to be an angel, a saint from now on. For the next 30 days, don't do anything without telling me, anything major without telling me. Now, the other thing that you're asking this in the context of credit, and I think some useful credit sets that we can share with the audience. A lot of clients will use their credit cards for the purpose of points and then pay them off every month, right? But at the time the billing cycle is ending, they might be carrying a balance, and that can really swing a credit score. So as a best practice, I would encourage every one of your viewers to look at all their credit cards and understand when their statement cutoff dates are, and then go make the full payment 3 days before the statement cutoff date so that it has time to clear. Once that statement cuts off, that balance gets reported to the credit bureaus. And so you might be fully drawn on the card all month, but if at the time that the statement cuts off, you're at a 0, your score is not going to be negatively impacted. On the contrary, it'll be positively impacted, because the credit score algorithms are looking for how much have you drawn on your credit cards relative to the limit of the credit card. It's called utilization. So that is something major, where we see clients that should have 740 plus scores, they're carrying a 680 around with them because they're drawing so close to the limit of these credit cards and they're not timing their payments well. So that's definitely something to consider.
Yeah, that's great advice. I've seen that happen, where I've seen people pay their balances off every single month, and then their Credit Karma will show them like 60 points less than it should, you
Yeah.
know?
Yeah.
So that, yeah, great advice. As far as like you had mentioned, things to purchase, people are purchasing things. And I think like a lot of people think that, okay, I'm buying a property, I'm gonna need furniture, I'm gonna need to do this, I'm gonna need to do that. What advice would you give for that?
Yeah, a home, you always want to, cover yourself, and always, much like in renovation of a home, you want to account for the fact that you're going to have cost overruns. You're going to have cost overruns, and a home can be a full-time job if you let it get away from you. So there's a lot of effort that needs to go into furnishing a home, into purchasing a home, getting it ready for move-in, etc. Which again, that's where a professional like you comes in. But also something regarding to cost overruns. I think, especially for our South Florida market, this is very, very important. When a property goes to market, the tax amount for the property is disclosed, and it may be some random number that the seller is currently paying. However, that tax amount is going to be reassessed the year after the purchase, and that catches a lot of clients off guard. They don't think twice. They think the tax of the property is a fixed amount, but it's actually a higher amount, which can approximate 1.9 or 2% of the price of the property. And so, if somebody has been, a seller has been living in a home since, let's say, 1980, in other words, a very long time, and they homesteaded the property, the tax increase has been capped by the homestead exemption. So when that property trades and the value gets reassessed, we have a big jump in taxes, and that can really catch some clients by surprise. So mentioning the cost overruns made me remember to mention that.
Yeah, makes sense. Okay. So we know the expectations, we know the motivation expectations. So the third question I ask people are their concerns. So what are some of the common concerns you get, and what are some of the answers that you give with people that are looking to purchase now?
The most frequently asked question is once again related to credit. People want a mortgage, but they don't want their credit checked. And it's obviously, you're gonna have one or the other. And so there is a huge misconception around the effect of a credit pull on people's score. It is true that the score goes down when you check credit. However, it is completely blown out of proportion. One credit check, if I check your credit now, you might be affected 2, maybe 4 points, and those points will recover over the next few months. What people need to understand is that in order to trash your credit, you have to pull credit sequentially over a short period of time with different types of consumer debt applications. So for example, today I pull a credit card, I have my credit check for a credit card. Next week, a mortgage. The week after that, a boat. The week after that, something else. Those sequential and across different consumer lines, that will definitely impact the score. Now, also, clients are concerned with wanting to shop, right? If they talk to lender A, lender B, lender C, and they all want to check credit, oh, my credit's going to be trashed. Not true. So the CFPB, that's our watchdog, that is our regulator, stipulates on their website that a client has 45 days to shop. So you can pull it 100 times in a week, and it'll count with mortgage companies, and it'll count as one inquiry, right? So that's consumer protection. That's exactly what the CFPB is supposed to do. And so that is another concern, both related to credit, both on this. Absolutely, your credit is not some kind of a trophy that you want to keep hidden because every time somebody looks at it, it loses value. Okay, you want to use it for what it's worth. Okay, you've worked hard to get it, so use it. And I encourage every client to have their credit pulled and with a mortgage company. And if they want to shop, they just do them in a short period of time, so it counts as one inquiry, and there's very little to no effect on the credit score.
Cool. This is sort of to the side. You had mentioned earlier that once you guys do a deeper pre-approval than most companies, you have underwriting looking at it, and they can probably close sometimes 14 days or after. There's a term that some people know, some people don't know, like a loan approval on a contract, the finance approval or whatever. Typically with your lender, and I know it varies, different loans, different companies, and all that. If an agent is filling out a contract and it has a blank for that, the default is 30 days. Obviously, if we make it 30 days, it doesn't put us in the best position to get the property, accepted, the offer accepted. What would you say if someone went to you? And obviously, we know that there's going to be, it depends on how fast the person gives you the paperwork, depends on how responsive they are and all that. But an average consumer, if they do exactly what you say, and they have the call, that they're pretty diligent about with what they do. What would you say a good time to put on a contract for the loan approval period would be?
Well, that's a great question because we got to do it that client by client, right? So an approval has conditions. So when we go through underwriting, we will come back with conditions. Now, if the conditions are appraisal, title work, your updated pay stub, I say waive your financing contingency. We're going to appraise the property during the inspection period. If we have a value problem, we can get out during the inspection period. We'll rush it through. And that is how we're going to outcompete cash offers, right? But that is a squeaky clean approval. Now, if a self-employed client got approved, but they're pending a P&L, which could swing the debt to income ratio, I would be a little more nervous. I'd have to have a conversation with the client and say, okay, do we want to do a 14-day financing contingency? Is that enough time for you to get me that P&L that I'm missing so I can get your loan buttoned up? Or do we need more time? Do we need 21 days? So that's really going to be related to the complexity of a client. The simplest clients to deal with, of course, are the traditional salaried borrowers that really just have pay stubs and W-2s. And it's so clean. They work for a big corporation that we don't even need to have to ask them for pay stubs or W-2s because we can pull that information electronically. That's the easiest kind of deal. Those deals, I say, if we need to win the deal, if we need to waive contingency to win the deal, move forward. More complexity, more time.
Yeah, I guess in today's market, it's probably takes longer to find the property than it would take you to actually do all the work behind the scenes, right?
Absolutely, 100%. And it's so interesting that you touch on that, because what I want your audience to understand is that when rates were low, this was the size of our demand. Let's call it a soccer ball, right? And excuse me, this was the size of our demand. Let's call it a beach ball. When rates went up, the demand shrunk, right? Because some people were priced out and people got discouraged, both emotional and factual reasons. And so the demand went from a beach ball to a soccer ball. Here's the problem. The supply is still a tennis ball, right? So that's our choke point. So absolutely, we need to do all these things in order to be most competitive when going to make an offer.
Yeah, that makes sense. So the fourth question I ask people are, what are some of the disappointments they want to avoid that they've either had or that they've heard a friend or a family member go through? What are there any that you hear about?
There's one specifically very much at the top of the list, and that is something that is experienced more by an entry-level buyer. The number one regret of a buyer is putting too much down, and that can sound counterintuitive, but there's especially, I see this especially with millennials coming around for their second house. Now they want to trade up, but they want to keep the property they live in and they want to have it rented out. But the problem is they put too much down payment and now they shorten the down payment for the new one. So that is honestly for me the most common regret that a homeowner has. They want to drive down the expense of the house, which is great. It's very noble. But if you do it at the expense of preserving your liquidity for a future transaction that can further build your wealth, that's counterproductive.
Yeah, it makes sense because, I don't know the exact number and it varies depending on the rate and stuff, but every $1,000 does not lower your payment that much, right?
Right. No, it would have to be substantial. Exactly. So, $100,000 difference on a down payment is not a life-changing amount, because remember, most of these loans are spread out over 30 years. They're amortized over 30 years. So when you make that large change in today's dollars, 100,000 is a large change, but it's not going to make that much of a change. Yes, it changed, but not that much of a change on your monthly payment. The value of that $100,000 in your pocket is probably more than sitting in your home as equity, depending on what your goals are, of course.
Yeah, no, totally. Okay, so for this section, I want to pretend like I'm a buyer. I'm not sure what I want to do, and I meet with you, and
Okay.
I'm going to give you some objections. And I'm
Mhm.
not trying to get you to convince me. I just want you to be real, like we're having a conversation. Okay,
Yeah, yeah. I'll
like you
answer
always are.
I'll answer your objections with facts and data. That's the best I can do, and then just put it back on you to make your decision.
Yeah. So I'll tell you. So, a few months ago, I thought about buying. We weren't able to find a house, my wife and I. And now we're looking for homes. Obviously, this is hypothetical. We're looking for homes, and I see the rates have gone up. And I know you shared with me your story about, that you went through a tough time in your life. And a bunch of my friends and family are telling me not to buy now. What would be, and we sort of need to buy. What would be your response to that? What
Well,
should I
I think,
tell them?
yeah, I think the most important thing that you touched on is your need, right? Can you expand on your need? What is your motivation?
Yeah, so our kids are getting older. We want to get them in a school. We know private school is super expensive. We think we probably could afford the area that we want to live in, even if the rates are higher. But I don't know if you've ever had to deal with this, where everyone tells you you're doing the wrong thing. You just don't want to hear it. And we're
Yeah.
not so touchy where we're gonna let them tell us not to do something, but we want to have some good answers to tell them.
Right, absolutely. Well, look, I think first and foremost, nobody knows your situation better than you. And they are not doing the same level of research that you're doing right now, meaning having this conversation with me. They've gone about their day and they've given their opinion based on really what are just headlines in the mainstream media. And by the way, are you currently renting?
No, we have a home that we're selling. We
Okay,
think it should sell pretty quickly.
got it. So is the alternative then now either whether to buy or to rent and just wait and see what happens? Is that what's at stake?
It would probably be just to stay in the home.
Got it. Okay, got it. So I've lost my train of thought. What is the thing I was just talking about before?
Yeah, so we really want to move. We want to move. Our friends are telling us the
I
rates.
remembered
We
what I
should
remember
wait.
now. Yeah,
Okay.
I remember now. So there is the reason why people are saying that is because what they're seeing in the media. They're seeing that inventory is up 20% month over month. That number may be true, but it's also contextually misrepresenting reality, right? Because if I have 10 homes on the market at present, which is in other words very little, and then next month I have 12 homes, then really I had a 20% increase, but I still have very, very little inventory. The media will take that and they will sensationalize it. And if I can share my screen, I'll show you an example of what that looks like. Let me just let's see if Zoom. I have 4 screens going on, so hopefully Zoom doesn't fail. Let's see if it gives me a choice. All right, there we go, screen 1. So this is kind of what aunts and uncles and everybody biting at your ear with the negative news is going to be telling you. Can you see that?
Yeah, I can see it.
All right, so and these come from reputable news sources, right? So I can just get this into presentation mode. Okay, that didn't work. There we go. We'll go back to that one. All right, so the cooling housing market enters into the great deceleration. Home prices decelerate as the housing market downshifts. Buying a home at the wrong time can backfire big time. Here's why it pays to wait. What's important to understand is that all the people that are giving their, I guess, well-intended opinions are sourcing their information from this data. And this data, it has an element of truth in it, but you just have to understand that the media is in a position, somewhat of a conflict of interest between their consumers and them, because their job is to sell your eyeballs on looking at them, and sensationalizing something is the way to do that. And so there's a bit of a conflict there. So I think it's important for you to understand that they may be coming from a good place from the heart, but they could also be misinformed. So what I would encourage you to do, whether to determine as to whether or not it makes sense for you to buy, is to get with a local expert like Amit, who can explain to you how inventory looks. How inventory looks back in, say, 2008, right before the crash, and how inventory looks now. And we all know that the price of an asset is determined by supply and demand. So if I have a shortage of supply and I have steady demand or even rising demand because millennials are coming into their peak home buying years now, and they're a very big generation, then it's kind of difficult to lose money or to see the housing market correcting too much. So that's kind of what I would steer your attention towards if you're concerned about getting into a home that suddenly loses value, right? Understand what the supply demand dynamics are in your neighborhood so that you can determine if it's best for you to buy.
You know, I'm glad you brought that up because, like, for me with my clients, I try and look at different scenarios, right? If we go back 4 or 6 months ago, however long we're going, you have less properties to choose from. You probably are going to have to waive your inspection, probably going to have to waive your appraisal or pay way above appraised value, and probably settle for something that you don't want and pay a lot more for something that you don't want. Compare that scenario to today and probably going forward, where you have more things to choose from. You may or may not pay less or more or whatever, but you'll probably be able to have a better chance of finding something that you like. You're probably going to be able to do inspections. You're probably going to bid against less people, and you're probably going to be able to pay the appraised value for the property. Those are two very different scenarios, right?
Absolutely. It's so much more favorable now. I think, one of the things that is driving the lack of inventory was sellers who were willing to sell but didn't know where they would go. And now, with things becoming more rational, yes, slowing down, but slowing down from very fast speeds. I think we're still moving fast, just not as fast. And so it's a much more favorable environment to if you want to buy a house, if it makes sense for you to get out there and do it. The other thing that I wanted to touch on is, I asked you for a very specific reason. I asked you what's the alternative? Is renting the alternative? If you had told me renting was the alternative, I would be a little bit more affirmative towards you buying a home. And here's why. I'm going to share my screen again. This is what the trajectory of rents have done since 1988 is the slide. And take a look at this. So it's literally parabolic, right?
Wow.
So this is median asking rent across the United States since 1988. Now, the most astounding thing about this graph is not how vertical it's going. I mean, this is due for a correction, right? I mean, how much
Right.
vertical can this go? However, take a look at this. 2008 through 2010, yes, it went down, but it didn't go down that much. So you had a whole housing crash with a complete oversupply of inventory, and it barely budged, right? Really important detail. If you're both a tenant and a landlord, clearly a landlord is a great business, right? Because your rent just keeps going up. If you lock that expense of the property in for 30 years, you're pretty well hedged against inflation. Whereas with the tenant, being a tenant, you're completely exposed. So that's the reason I asked you about what the alternative was. We're renting or staying in the current home. And so that's also a very important detail for somebody to consider.
Yeah, definitely. Because a lot of people are, I guess they're called like nomads now. People are able to have a job in California or New York or wherever, get paid higher than they would in probably Miami, and work remotely. A lot of these people, I'm getting calls that are looking to live here like 6 months in a day, rent out the place, like Airbnb, short-term rentals and stuff like that. I know it's a very confusing thing, especially how South Florida, where you can do it, where you can't do it, restrictions and all that. Can someone borrow if they're buying something like that?
They absolutely can. They absolutely can. A lot of conventional programs won't allow for financing in what's called a short-term rental building. So those short-term rental situations like condo hotels, for example, performed very badly during the crash. So statistically speaking, when we look at the performance of the loans, they have a history of performing worse. So they are priced different. They put place in different programs. However, despite that, I think the big picture is if that is somebody's motivation, and I'm dealing with this right now with an Instagram influencer living in New York who wants to homestead here, so that there's a tax advantage. The big savings there is the tax advantage. That's why people earning high dollar in other places want to work remotely from Florida, because there's no state income tax, right? So absolutely, they can get financed, and this is becoming. Developers are recognizing this this need from both owners and users, primary residence people, and investors. And more we're seeing short-term rental buildings coming up, with several about to hit the market as we speak. So for somebody in that situation, I really encourage them to get in contact with somebody like you, so that you can explain what all the options are, the different buildings are, but they can definitely get financing.
So if we find something, because what I've noticed for newer buildings, new construction, it's not that difficult to get a loan always with that. Usually a developer has someone, or the person has an agent or whatever. But I see like resales are much more difficult. So if someone, say I have a client, we get a call once or twice a week, someone that wants to buy a short-term rental. If I send them your way, would you be able to get financing? If their credit's good, they can prove their income, they're like a normal person that would qualify for a mortgage.
Yeah, 100% yes. This is a weekly request, right? So very important. If everything checks out, credit, income, assets, just the fact that they're purchasing in a short-term rental building is not a deal killer. It is still a doable deal. They might not get the same rate and say if they were purchasing a single family residence, right? If you're comparing everything else as being equal, but it's still very much financeable. We recognize the demand in the market for it, and we're supplying the solution.
Is there a minimum down payment, or does it vary?
Great question. Short-term rental buildings are going to require a higher down payment. So whereas, let's say in a house, a single family residence, I could get you in as low as 3% down. That's not going to be possible in a short-term rental building. Short-term rental building, you're looking at no less than 20%, and in some cases 25 to 30.
Okay, so it's still not too bad. 30%.
Not bad. Not bad.
I remember, I've been doing real estate a while, and it's my 18th year doing it. And when the market crashed in the past, I remember condos, you had to put 25% down always. So 25 to 30% down in a property that potentially is going to give you income and you can make money. That doesn't sound like a bad deal whatsoever.
It's not a bad deal at all. And then throw the tax savings, the income tax savings on top of that, if they're moving from a high tax state, then it's a no-brainer.
Yeah, totally. So I pretty much covered everything I wanted to cover. What would you like to cover that I haven't covered? Is there anything?
Yeah, I mean, look, there's always plenty of real estate. There's always plenty to talk about. But I think, the most important take-home message for your audience is leverage the experience of a local professional. I see, obviously, when you're dealing with a real estate agent, you're local for obviously, so they're dealing with a local professional. Then when it comes to financing, I do see a lot of loans that have gone sideways due to out-of-state pre-approvals. Every local market has its nuances, especially in Miami when it comes to condos. So, it behooves you to get a second opinion at the very least from a local professional, because I do a lot of risky deals. Risky deals, somebody who comes to us 2 weeks before close, like, oh my gosh, Rocket Mortgage just declined me. Better.com just declined me. It's like, yes, .com just declined you. That's what they tend to do. So, so that can really be avoided. That whole hassle and that risking the deposit issue can really be avoided. Deal with the local, get a second opinion from a local professional if you're intent on using from out of state.
So tell me something about Cross Country Mortgage. Tell us a bit about it.
Sure. National company. We're in 50 states. We did about 150,000 transactions last year. So that makes us a pretty large non-bank lender. The thing I love about Cross Country is, there's many, but the one that stands out to me is just the plethora of programs that I have to offer clients. A lot of my career, the majority of it was spent at banks where my product box was this big, right? I had to get clients into this box. If they didn't fit this box, couldn't help them. I'm living in the complete opposite world. And it's just really encouraging to be able to, talk with agents, talk with clients, and let them know, look, in all likelihood, there's a very high probability I can get you a loan because I have just so many options.
Yeah, no, that's great. We do see that a lot. We have some people that have their friend or relative that does loans, they speak to them, and then they may not qualify. And then we speak to someone else that has that huge box like you have. And then, there's so many different opportunities besides the savings a lot of times, as far as you, I know one of the things that I like about you, besides you make everything, you simplify it, is that you do videos on this stuff. So, can you tell people where to find you on YouTube? It probably is going to take you a while. Can you find it on your screen and share it, or is it going to take you a bit?
No. Let's do it right now. Let me. I don't know what my channel URL is.
That's all right. Maybe Google it yourself. Maybe I knew I had to do something before we went on, and I forgot.
You got me. So there's two ways I can get to the videos. And what this is it's a monthly video. I like to geek out on market stuff. So market data. So I pull them on a national level. I have a national audience, so it's it's on a national level. And I do a once a month monthly report, and they can find it on my website, which is Paulo Rodriguez. It's my name, paulorodriguez.com, and then they just click on monthly reports at the top of the page. My cell phone number is also on there, so it's useful to have. It's paulorodriguez.com. And as far as the channel is concerned, I'm looking at this really long, ugly URL. I don't know if I should put that in the chat or.
If you could just share the screen, then they can at least see it. If you can find it.
Let's do that.
Cool.
Let me share my screen. And
the reason I say that is because we're in the world of NFTs and stuff. So my Twitter has my NFT instead of my face. So people will go and they'll be like, who's this? I went to a page, it had your name, but I had no clue who it was.
Hold on one second. Sorry, this thing's talking to me.
Sure.
There we go. Sorry.
That's okay.
So you have your NFT on Twitter. That's interesting. I got to look at that. But I don't know if I'm sharing the right screen.
Yeah, I see it. It looks exactly like you.
Okay, hold on a second. I thought I was sharing my calendar for everybody to see for a minute.
No, I saw your YouTube.
Okay. Zoom kind of had the little box in the wrong place.
Right.
But let me know if you see it now. I guess it's just called Paulo Rodriguez. But it's that ugly long URL there. That doesn't really help. So I need to take a look at how to change that.
Yeah. Okay. Cool. Yeah, because in the past, when I've seen other mortgage people, mortgage professionals share information, they make it difficult to understand. But you share it you speak to the person like their family, right? You're not trying to convince anyone to do anything. You're just sharing the information. And that's a lot more powerful, I think.
Absolutely. And I think we have to take responsibility because, if you push somebody into purchasing a home, you're essentially giving financial advice. Right. And that's it's a place where you want to tread very, very lightly. So, for a client to advance with me, I want two things to happen. I want them to mentally check out with facts, but also their gut, their heart, right? Emotionally, are they vested in this? If there's a lack of congruence between those two, it could make for a bad decision on their part and a very difficult transaction for everybody involved.
Yeah, absolutely. I'm going to share something on my screen real quickly. Our team has been working on this for the last 15, 16 months. So when people move to Miami or they're coming to Miami, I'm sure, Paulo, you have people all the time will tell you, hey, I'm going to be visiting Miami. What should I do? Where should I go? And stuff like that. Probably all the time, right?
All the time. Actually, it sounds like I could get a benefit from this, and I live here.
So we created this. It's called, the website is Miami Neighborhood Guide. It goes to a different site, but it's miamineighborhoodguide.com. And so what we did last year is we broke down, people know Miami as Miami, but they don't know it as Allapattah, Wynwood, Edgewater, and all that. So we broke it down into 40 or 50 different areas. And each one, like say it's Aventura, explore Aventura. I'm gonna click on it and tell me if you can see what pops up. Can you see what
Sure.
pops up?
Yeah, absolutely. Explore Ventura.
So so we
Awesome.
talk about Aventura. We'll have pictures and stuff like that. Then let me see this. Let me see if I can go back. I'm gonna stop sharing for a sec. Go back to this and share it. Okay, so then we'll have a blog of like 5 things you may not know about Aventura. Then 5 things to do in Aventura. 5 places to eat in Aventura. 5 restaurants to eat dessert in Aventura. And this is the one that's taken us the longest time. I probably invested about 100K into this.
Oh boy.
Yeah, it's a neighborhood video. So we do like a drone, and hopefully you can see this.
Sure
You
can.
probably can't. Okay, cool. So I'll just forward it. So it's like a short video of the area and restaurants and things that you can so you can expect where to go and how it is. And we have like 50 different areas. So we're thinking of as insignificant an area as we can think of and making it. Like the last one we did was Tamiami, Westchester, and just places that people don't know. So
That's
yeah,
mind
so
blowing. That is
oh,
mind
thank you.
blowing. Wow, that's awesome. I'm going
Thanks
to
so
check it
much.
out. I'm going to check it
Thank
out.
you. We both like to share, and I'm gonna make this into a podcast as well. So I'm gonna have your information, Paulo, on both YouTube and everywhere else I share. I would highly recommend you guys to reach out to Paulo. You know, I've been doing this a long time, and I meet a lot of different people, a lot of different lenders, and there's probably a handful that are exceptional, but I really like, Paulo, that you do like preventative maintenance, right? You know the things that are going to go sideways, but you just don't tell them like you need to do this, this, and this. You also tell them don't do this, don't do this, and you're okay. You're like you'll save the deal as well. Obviously, you're going to do a lot better as a consumer if you start from the beginning, because you know there are a lot of different nuances when people do this. You know, some people get gifts, some people have their bank accounts a certain way and all that. I think I would just highly recommend, if it's a family member, I'm going to send them your way. So whoever can go out to Paul, and this isn't like he didn't tell me to do this, but just from getting to know him and seeing how professional it is, it makes my job a whole lot easier. Because even a smooth transaction, it's like a marriage, right? Even if you meet the best person in the world and you get along really well, there are going to be tough days and not, you know, and great days. And that's sort of like with a mortgage, but on steroids, or a purchase. So if you, so definitely reach out to Paul. I think it'll help you a whole lot.
Thank you, Amit. Those are such kind words. I really appreciate you. And I mean, I want to just take a moment to echo what I feel about you, because one of the things that stood out to you, stood out to me about you, is how much you care about your client. And you know, hence why the topic of this chat was why you should not buy a home, right? Because we're not just trying to ram a transaction down the client's throat and make a commission. So the thing that stands out about you, and I think what I encourage every prospect, every buyer or seller interested in the real estate services to consider you, because you're going to be looking out for their best interest. One of the things you mentioned to me when we were talking about doing this chat was that you are looking to create a client for life, and a client for life is created by trust. It's not created through a transaction. And so I think that any client looking for somebody who is looking for objective advice, and who is looking to be advised according to what their life circumstances are, combined with 18 years of experience like you have, should be reaching out to you.
Thanks so much. I appreciate it. And if you guys have any questions, whether it's on the podcast, YouTube, or whatever, reach out to us. We'll be happy to help, because you know we can't go over everything, and everyone has different situations. So just please reach out to us. Thanks so much for watching, guys.